I'm going to kick it off here and get this started. We still got some people rolling in, but I wanted to thank everyone who's on the call now and everyone else that's dialing in for attending today. So we have a really good presentation on deck. We have our good friend Phil Kerchak here from PIMCO Investments. Is going to be giving a presentation on behavioral guidance during market volatility. This will be a recorded session, just a few housekeeping items in the beginning. It's a recorded session. We'll get some notes, the recording. PIMCO has been kind enough to provide some additional resources as well for investors that we'll get out to everyone once the meeting's over. We're going to keep everyone muted for now. We will do a Q&A at the end of the presentation, so feel free to unmute yourself at that time if you have any questions, or you can use the chat box as well to ask those questions, and we'll get those answered. So let's get started. Phil, thanks for being with us today. So again, I'm Ryan Staton, for those that don't know, managing partner at StatonWalsh. We have Phil from PIMCO on the call today. Some great insights in this presentation, definitely something that I think has been relevant over the past year with everything going on. And Phil's going to do some great work, or go over some great information about just market volatility, some statistics on how investors have performed, and talk a little bit about some behavioral biases and some other things about how investors behave in volatile markets. So I don't want to steal any more of his thunder. I'm going to turn it over. So Phil, thanks for being with us today, and take it away.
Thank you, Ryan. So just confirm you can, again, see the screen and you can hear me clearly.
We can.
Excellent. Devin, Ryan, thank you very much for the opportunity to engage with some of your top clients. And it's a pleasure to meet all of you today. Just so you know kind of what I do, I partner with financial planners such as those at StatonWalsh, just to help bring value. I'm more on the investment side, but what we've realized there are a lot of non-product specific topics that are kind of top in mind for people today. And I may be referring to Paul and Barbara a couple of times throughout my discussion with you today. Paul and Barbara are my mother and father-in-law, and whenever I try to talk about what I do in financial services, if their eyes start to glaze over, I know I've gone the wrong direction. So it's going to be one of my goals today to not have your eyes glaze over. We're going to be speaking about, I know the title is Behavioral Guidance During Market Volatility. What does that really mean? I'm going to refer to investors. I'm not going to speak at you as investors. I'm going to refer to us, because you know what? Ryan's an investor, Devin's an investor, and I'm an investor. And you know what? It's a heck of a lot different to speak to somebody about their money. And sometimes when I'm talking to my own advisor about my own assets, it's a very different feeling. And it's almost like everything I've learned and everything I help educate clients about briefly goes out the window, and I need to be reminded, right? I need to be re-educated. And that's really the role Ryan and Devin, I'm sure, help play for you all, other than just the stewards of your financial assets, goals, and dreams. So that's kind of the goal here today. I'd like to keep this pretty much at a high level. You may see a couple charts in here. Don't get scared. I realize charts, statistics doesn't sell anybody. It's really the story that creates that emotional connection. And that's one of my goals here today. So all that to say, thank you for spending some time today. I am going to go through some really, really important concepts around behavioral finance, particularly how we feel and how we react when markets go bonkers, right? That's basically what volatility is. When stock and bond prices go up and down, when markets get stressed, or we can just call it what it is, when markets go haywire and the stuff hits the fan, right? What Ryan and Devin do for you as financial advisors, as financial planners, really one of the things I know that they try and do is help put you in a better position than you were in before you beckon their doorway. And one of the things is to help guide you through your own emotional volatility, right? And again, this stuff crops up when the markets go haywire. And remember, extreme stress in the markets not only affects us financially, but it also affects us emotionally, right? I think if we just remember looking at our statement after February and March, right? Looking at our statements after 2008, right? Very different feeling than perhaps looking at a statement today. So let's kind of jump in. This is a straw man of the topics we'll address today. We'll talk briefly about market volatility or market stress. We'll introduce you to the concept of behavioral finance compared to conventional finance. What are some common biases? What are basically these defects and shortcomings that make us human and cause us to draw bad conclusions? And then we base decisions on those conclusions, and guess what? We come out with less than par outcomes. Then we're going to hopefully walk away and provide some strategies to help mitigate these biases to have better outcomes. So that's kind of the goal here today. So first, scary chart, right? The only thing I would point you to is really where that line spikes. Now, what this is a measure. There's something in the markets called the VIX. It's an index that measures really investor fear, right? And as you can imagine, you tell me, now I know it's not really a two-way discussion yet. I know we'll have some Q&A, but just asking rhetorically, where do you see the biggest spikes? What time frame, if you look at the bottom of the chart on the x-axis? They happened in 2008, right, the great financial crisis, and in 2020, right, during February when the markets went down, I think, what was it, 40, 50% in 22 days. The fastest and most violent drop in the market since the Great Depression, right? So now, when we think about this, it's important to remember what causes this, right? We saw different shocks associated with demand, right? We were all basically sheltering at home, so demand for goods and services dropped. It was also a supply shock, right? We hear about the global supply chain disruptions. We're seeing it right now with a big fat tanker kind of clogging up the Suez Canal, right? Financial market shock, where we see everybody say, oh my God, screw it, get me out of stocks, go to bonds and go to cash. We see that flight to quality, and we also saw an oil price shock. So all of those things together caused one of the biggest outlying events that we've really ever seen in the markets. Just to move on. So an introduction to behavioral finance. Now let's kind of define it and why it's important. First, in thinking about what Ryan and Devin do for us all, right? What your advisor does, what my advisors do. Many of us assume it's to buy and sell stocks and bonds. And quite frankly, when I came in the business in 1998, I thought that's what my role was. Nobody told me that, no. One of the key competencies that we need to show our clients is to help manage their behavior, right? To help manage their emotions, to help them, you all, us investors, make better decisions to have better outcomes. Now, conventional finance suggests that individuals evaluate their options and then they make rational decisions. We make rational decisions to achieve best outcomes. Well, in the real world, decisions are often not made that way, and we don't often process information correctly. We make mistakes. We are humans. We are not dispassionate, and we are fallible. As a result of that, these behavioral biases, and I'm going to go into some detail in a moment, often have a really big impact on both the decisions that we make as investors and the outcomes that are eventually realized. So let's take a closer look at the costs of these poor investor behaviors. So the question, do poor investment choices really matter? I mean, don't they just even out at the end? Again, don't be scared of the chart. I'm going to walk you through it. It's a lot simpler than it looks. So here's what might be a very compelling example by our friends at Dalbar. It's not important to know what and who Dalbar is, but I know Ryan and Devin will. They're an evaluator and a ranker of insurance companies, of asset managers like PIMCO, which is who I work for. But what is important here, folks, is they've been laser focused on investor behavior for the last 3 decades. And what they have done here is they are showing the cost of poor investor behavior. So what we see here is this slide looks at the return of the S&P 500. Now, raise your imaginary hand if you know what the S&P 500 is, right? If we're thinking about equities, if we're thinking about stocks, we're probably thinking about the S&P 500. So it shows us the return of the S&P 500 over the last 20 years on the left, that's the blue, and the 20-year average for equity investors. So the difference is you have the investment return on the left, that's an index, no hands in the cookie jar, and on the right you have the average equity investor. What do we notice? Well, the research studies suggest that the investor return on the right is often very different than the investment return on the left. The results are often dependent on our behaviors, not only which assets we choose, but when we choose to invest and the decisions we make along the way to either add more money or withdraw money, right? The numbers on the slide show on the left a little bit over 6% in the S&P over the last 20 years. Now, the average investor, the fallible human, you and me, unfortunately, earns substantially less at 4.25%. That's a difference of 1.8%. Now, the question is, okay, so what, Phil? Is that significant? Does it matter? I don't know. Let's take a look. It depends. Let's put some numbers behind these behavioral differences to really understand the impact that our behavior might have on our returns. So, again, let's raise our hands. Anybody invest in a retirement plan? I know there's some self-employed people. Maybe you have a SEP or a simple, maybe even you have a 401k, 403b, whatever it is, right? So what we're doing is we're showing here the cost of these bad behaviors between investor return and investment return and how significant it can be. So in our hypothetical example, we're going to assume the investor adds, now a little quiz for you all, how much can we add to a corporate sponsored retirement savings account these days? Let's say a 401k. It's $19,500, right? That's the maximum 401k. At least that's what it was in 2020. I don't think that's gone up. I could be wrong. Now we're going to assume that the investor, the retirement savings plan investor, makes regular contributions to the plan for 40 years. Boy, wouldn't it be great if we had that discipline for 40 years? So what if the investor in this scenario earned the return of the actual market? So we're talking about the investment return, right? In blue, that's the 6.06%. What's the investment result when we retire, right? Now we have our retirement party, we look at our account. In this example, we're left with just a little over $3 million. Now, what about the investor? This is more realistic. This is you and I, on the other hand, that earns the 5.25%, that maybe made some moves along the way. You saw volatility, you got scared, and you sold off some of your stocks. And then as stocks went back up, maybe you bought back in, right? All of these moves, there are costs to that. And right here we see that annualized 4.25%, what did we wind up with? Under $2 million. That's a 56% decrease. Over $1 million less because we just acted human. It's not our fault. The greatest cost to us as clients may be the cost of poor decision making without Ryan and Devin's help. That's what they can do for us. I hope that makes sense. So let's look at what are the actual things inside us as humans that cause us to act out, right? Loss aversion, recency, anchoring, and hindsight. I don't think we're going to go through all four of them. But these are some of the biases that investors are often found guilty of. And we're often the guiltiest when markets are the most stressed, right? When markets are going haywire. So let's take a look at a couple of these. First, loss aversion, right? Where am I? Okay, so loss aversion. This actually might be the most powerful of all the biases, right? It's premised around the idea that the pain of losses is twice as great as the pleasure of gain. So if we go to the mailbox, we're looking at our statement and we see a loss, research tells us that feeling is twice as intense as the joy of seeing a gain. I don't know if there's any basketball fans out there. Larry Bird said it. I know we're in Maryland. I'm in New York. I'm not a Boston fan. There's not a lot to root for in New York by way of, well, actually, the Nets are pretty good, but that's besides the point. Larry Bird once said that losing hurts worse than winning feels good, right? And it's this loss aversion that leads us to some pretty interesting behavior. Some of them are on the screen here, but I'll just walk you through it. Loss aversion often prevents us from unloading an unprofitable position. I'm going to refer to Paul and Barbara, right? We both, I should say Paul and I both bought Alibaba, kind of like the Chinese Amazon, years and years ago. We bought it at $90. It was almost like the second we hit the buy button, the thing went down to like 60. Now, at the time I was 40, Paul was 70 and had been retired for 15 years. He was a appliance store owner, a small business owner, like all of you out there in the Bronx, right? So he felt that pain big time, but he didn't sell it. He held on to it, and he felt that pain multiple times a day that he chose to hold on to that unprofitable position. You know, kind of praying to the equity gods, please get me back to 90, get me back to 90, and then I'll sell out. He actually was disciplined. He held it till 90. He sold out. I don't know if you know where Amazon is today. It's at about 240 bucks. I'm still an investor. I'm not saying that to brag. I got lucky. I have a longer time horizon. But the point is, the agita and the pain he felt inside prevented him from unloading an unprofitable position. Also, sometimes we double down on unprofitable positions, hoping that we eventually rebound to either eliminate or reduce the probability of loss. Think of, I'm not a gambler, but think about being at the poker table or the blackjack table, right? We're losing. All right, let me double down. Just get me back to zero and I'll walk away. So these are some examples of loss aversion. All right, moving on to recency bias. This is another scary chart, but this is one of my favorite ones, and I'm going to walk you through it, right? Recency bias is also called trend chasing, and it's also called pattern following. This chart illustrates the return of a 60-40 portfolio, which that means 60% stocks, 40% bonds, right? A balanced portfolio. What it also shows us is the corresponding investor behaviors over a pretty volatile time period, right? For those of us that were investors in the market in 2006 through 2010, very different, almost like two different markets from 06 to the middle of 08, and then the middle of 08 to 2010. Just as a point here, it's easier to emotionally validate a choice when we're following a trend, right? I'm okay being wrong. I just don't want to be wrong and different, right? So what I want you to do is, if you take a look at the line in the chart, that's the 60-40, right? That's all along the way. That's just the performance of the 60-40 portfolio. If you see these green bars going up and down, that's actual money going into and out of these 60-40 funds. This is what you and I are doing on a monthly basis. So I want you to notice the almost perfect relationship, the perfect correlation between when that line is going up. And I don't know if you can see it. You'll see the investor emotion at the top, right at around mid-2007. What does it say? It says, I'm so happy I invested when I did. And I know you're always calling Ryan and Devin, patting them on the back. You guys are the best. You rock. Give me a virtual high five, right? I say that tongue in cheek. But what happens is you see money, those green bars are above the 100,000 line. So money's going in as the market's going up. Now what happens is the market takes a turn in mid-2008. Uh-oh. So we're starting to feel new feelings, right? There has to be a recovery soon. Well, now what happens is in mid-2008, now we're below the 100,000 line. Now we are in unrealized loss territory. right? We haven't realized anything, but now we're in the red on our statement. So a common emotion elicited from an investor at the bottom is, if you see that, it's right there on the chart. I can't take this anymore. I'm out. Now, what we know from having been investors for a while and in the markets for a while is markets typically normalize. And when they do, those that had a disciplined approach in place, that worked with an advisor like Devin, like Ryan, that help manage your emotions, particularly when times get tough. And you're going to see in the end here, take a look at the blue line all the way to the right. What's the dollar value from that $100,000 investment? It's $111,000, right? Didn't knock the cover off the ball, but at least you're a positive. It was a rocky ride, but because you stayed the course, in this example, you wound up making money. However, the poor investor at the bottom that sold out of fear, they tried to catch that falling knife. The market starts to rally. They say, uh-oh, I better get back in. Now I'm buying on the way up. What this investor did was they sold low and they're buying high. And you see the result. What did that investor wind up with? $93,000. Folks, the difference between the 111 and the 93 is the cost of our poor investor behavior, right? That makes sense. So recency bias is the greatest contributor towards the difference between market returns and investor returns. Moving on. I'm going to skip these two. All right. So we talked about the problem, right? We're human. It's not a problem to be human, but there are things that cause us to react certain ways. And it leads us to make, maybe erroneous conclusions. We base investment decisions on those conclusions, and we have suboptimal results. So let's start to live in the solution now. Let's put the problem behind us. What are some ways we can mitigate behavioral bias? So here's a study by a firm called Cerulli & Associates. I know Ryan and Devin will know them, that reviews some of the most common behavioral bias mitigation techniques. What could we do? And this may sound really, really simple, but it's really, really important. And actually, we've got an investor volatility checklist that we're going to get to you after the session. One is take the long-term approach. Unless you walked into Ryan and Devin's office and said, listen, I want you to put a financial plan together for me for the next 12 months. I doubt that conversation happened. It probably was more like a lifetime, and then talking about your offspring and generation to generation. So make sure to maintain that long-term approach. Also, make sure you have a process in place, right? Maybe doing something on a systematic basis like dollar cost averaging or systematic withdrawals. How about integrating goals-based planning, right? Bucketing. They may have spoken to you about this, like, hey, I've got this short-term goal. Maybe I want to buy a house, I want to buy a boat in a year, but I also got to put the kids through college in 5 to 7 years. And, Paul and Barbara, we want to retire in 20 years, right? Those are goals-based investing, and there are different ways to invest for different goals, right? Bitcoin is probably not the most prudent way to save for something 6 to 12 months out, right? It may not be prudent at all, but that's a discussion for another day. And then diversification. I want to give you an example. I lived out in Arizona after college, and I worked for a company called Vanguard. Some of you may know them. And I worked in a division called Participant Services. My job, so Vanguard was a custodian and a trustee for many, many 401k plans. So this was back in the early 2000s. Excuse me. No, this was in 98. Two of the companies that we had as clients were Enron and WorldCom. Now, we may not have heard those names in a while. WorldCom may be sound less familiar, but we should know Enron, right? What I saw were people calling me up. They wanted to borrow from their account, but the accounts weren't diversified, meaning they had one position, 100% invested in Enron company stock. So when Enron went bankrupt, we saw people's retirement plans disappear literally overnight. Diversification, it's not complicated, but it's very important to help smooth out the volatility, to smooth out the stress we may feel both emotionally and financially. All right, so identifying behavioral risks. So here are some questions that Ryan and Devin may have posed to you, and they're good questions really for all of us, even to ask ourselves along the way. So let's rewind. Let's go back 12 months in February, March, when everything in the kitchen sink was selling off, and it was tough walking to the mailbox in early April and seeing that first quarter statement. A question to ask ourselves is, how did this recent market stress affect me? Has it changed my long-term goals, right? If it has, that's a conversation we need to have with our advisor. Are we comfortable with our current allocation? I mean, are we comfortable with our current equity exposure? If not, what changes should we make? Here's an interesting question. If we received a windfall of new money today, maybe Paul and Barbara passed away, we've got some assets now. Given the current levels of stress in the markets, how would we invest those dollars today? What would be most important to me? Would it be regaining the value of the portfolio that it was lost, or would it be protecting what we have today? Right. So hopefully these kinds of questions are a good starting point for an in-depth dialogue with your advisors. All right, another scary chart. Shouldn't really be too scary. This is really more for Ryan and Devin. So these are the range of returns for three of the most common asset classes: stocks, bonds, and cash. Okay, this is going back pre-depression. So this is a pretty good sample set, about 95 years. And we see here that the annual return for T-bills, right? That's what we're using for government bonds. By the way, T-bills, bonds, that's, when we see that the 10-year treasury going up and down, that's pretty much what that refers to. The compound return for T-bills was 3.3%. For bonds, that's really the 10-year treasury bond, about 6%, and stocks was about 10%, right? So while we look at the average returns, right? Well, stocks will get me 10, bonds will get me about 6, and T-bills or cash will get me around 3, which we all know CDs and cash don't really get us 3 today, but this is just about averages. But the point is, if I want the higher returns than stocks give me, right? So we're looking all the way to the left. We see that 10% number. That sounds pretty sweet, right? I would sign up for 10%. We have to also look at the range of returns. So what does that mean? If I want the higher returns that stocks provide, I have to be willing to accept the greater uncertainty of my annual performance might be. So all the way on the left in that royal blue, we see how high did stocks get on an annual basis over the last 95 years. What percentage? It touches 50%. That's really sweet, right? But now let's go all the way below the zero barrier. How low did it get? Right, we saw this in 2008, down 35%, right? So are we willing to accept a possible range of almost 90%? That's not for me to answer, but that is important to understand, right? So the longer term investment, the longer term thought process helps reduce the risk that we take as market participants as our potential range of outcomes is more narrowly defined. So again, it's time in the market, not timing the market. So don't beat up Ryan and Devin because maybe we got a call wrong over 12 months, right? It's not timing the market, it's time in the market. I'm going to skip this one. All right. Love this slide. There might be smoke coming out of your ears by this point, but we're kind of in the home stretch. This is an example of rebalancing. Now, there are questions. I get these all the time, more so from advisors, less so from Paul and Barbara. They Phil, what does PIMCO think? How should we rebalance? Do we do it periodically, like every 6 months? Do we do it every year? Or should I do it when certain thresholds are breached? Like, oh, my stocks were at 70%, now they're 20%, whatever it is. So I want you to think of Nike. What's Nike's motto? I know it's an Under Armour world, but remember Nike? Just do it. We think it's more important to just doing it than the manner in which we rebalance. So I want to give you an example. On the left, we've got $1 million portfolio in 2008. Okay, the portfolio is allocated 70-30. 70% in stocks, different equity. You've got large cap, small cap, international. It's also broken up between growth and value, and 30% in high quality, high liquid fixed income. 70-30. Okay, I want you to look in between the two pie charts now. This is the performance on December 31st of 2008. Not to make us relive it, equities had a rough time. All 4 equity strategies, US large cap growth, large cap value, small cap, and international, they all got beat up and beaten down pretty good, right? Down anywhere from 35 to 40%. The only asset class that held its value was fixed income, right? I want you to think of bonds as the bubble wrap for your equities. That's the business I'm in, but that's besides the point. Okay, now the pie chart on the right-hand side, you'll notice 1 year later, so on the left is January 1st, 2008. On the right is January 1st, 2009. It's a mess, right? First of all, the $1 million is now what, folks? 753. So the portfolio lost 25%. Well, why didn't it lose the 35 to 40? Because the fixed income helped protect our downside, right? But the point is that the 70-30 is now closer to a 60-40. In fact, it's now more 58% equities, 42% bonds. Why is that? Because the value in our equities lost more at a bigger chunk than our bonds did. So now we are underweight equities, right? Because we were 70, now we're 58, and we're overweight bonds. We were 30, now we're 42 compared to our original allocation. So at this point, what is the investor's temptation? Think about it. Maybe think about what you did in 2009 or what your conversation was like after the stuff hit the fan. Many investors are tempted to not add money to the equities, right, to buy lower, but they're tempted to do the opposite. And perhaps showing frustration, they choose to move out of bonds and into cash. What do you feel is the most likely outcome? Now, what we know is disciplined rebalancing would have required you to add money to the assets that were undervalued and take money out of the asset class that did well. Rebalancing forces us to do what is emotionally uncomfortable, which is to sell the winning asset, the bonds, but winds up being emotionally and financially productive, which is to buy more of the losing asset. For the investor and the advisor that rebalanced, let me back up. Let's say they didn't rebalance. It's a typical investor. You know what? 2009, if you just let it ride, you did pretty well. You were up 19%. Well, guess what? If you have an advisor and an investor that has a disciplined strategy in place and you rebalance from that mess on the right back to the portfolio on the left to 70-30, you were up 22%. That advisor would have added 3% of incremental return. And if you compound that over time, that is a very, very powerful tool. So the point is rebalancing helps guide us through periods of emotional volatility to instill some discipline and help us increase the probabilities of successful outcomes. Also, we talked about asset bucketing, right? Think of this also as mental accounting, right? It asks the investor to identify individual financial goals. What's the time horizon of that goal? How much money is going to be required to achieve that goal? And what's the appropriate level of risk to make sure we don't jeopardize that goal? So I used a couple examples before. Take a look on the left on the chart, right? One of them, my short-term goal may be to buy a second home in 6 months. Should I use Bitcoin? Probably not. I can't advise you, but perhaps something safer, right? Like cash or fixed income or a CD, right? The point is to not juice up the return, but to really focus on capital preservation, right? So asset bucketing helps us accomplish two really important goals. One, it helps minimize the risk of not hitting our near-term goal and assuring a high probability of success. And second, it allows us to invest other dollars for other goals in a more appropriate fashion relative to that specific goal. There's a glossary of some of the terms that we went through. You're going to have a copy of this presentation when we're done. That takes care of my prepared remarks. I apologize, I went over by about 4 minutes. I hope you found that useful. I love talking about this because this is real life stuff. And you know what? Stress in the markets isn't going away. We've got potential tax reform coming down the pike, even though PIMCO thinks it's going to be more evolutionary, not revolutionary. We don't think it's going to be retroactive, and it's going to hit more so the high income earners. But there could be some changes for small business owners such as yourselves. But listen, I want to thank Ryan, Devin, all of you for allowing me to spend time with you today. I'll turn the floor back over to you.
Awesome. Thanks, Phil, and thanks for working through that presentation with us. Like you mentioned, this will be this session is recorded, but the presentation will be sent out to everyone that RSVP'd. We're also going to offer, there's a checklist that PIMCO actually provides that goes along with some of the things that Phil talked about within the presentation that we're going to also make available as an investor education piece. So now we're going to transition into our Q&A portion. I believe anyone who has a question, you can either feel free to drop that in the chat box, or you should have the ability to unmute yourself. So let me know if anyone can't do that, but we're gonna open it up to questions. See, we have a
Hey, it's Walt.
We have a hand raised. Yep. Go ahead, Walt.
Okay, I hit the button for raise hand.
There you go.
Yeah, so I guess maybe you have this number, but what's the percent of individual investors versus institutional investors? And I guess the reason I ask that is, you know, I guess I took a weekend class up at Tyson's Corner, I don't know, a couple years ago, and they tried to get me into this trading, some kind of trading group up there. And I thought, you know, I probably don't have the intestinal fortitude for doing that. But, you know, they were basically saying that, you know, the little guy's always going to get crushed by the institutional investor, you know, just when the market's at a certain point and then these institutional folks say, okay, now it's time to unload, and they just drop a bomb. And then, you know, they have the strategies where they're buying down as well, and they're making by shorting the market. So they're making it up and down, where those of us who aren't, you know, into that or don't have that kind of knowledge or whatever, you know, patience or intestinal fortitude, you know, never can do that. So yeah, I see this thing where you say, okay, you go out and you get a portfolio and you just hang in there, and say you hang in there for 10 years, it goes up and down, and say, okay, and your average returns are 7% over 20, 30 years. And you say, well, yeah, and if you don't, and you do the behavioral thing, you're down at 4.5. So I get that as well. But is there an intermediate strategy where your investor or somebody basically says, yeah, you know, we know what these cycles are like. We know when the institutional people are hammering this thing, and they're making money going up and down. So they don't really care which direction the market goes, because they have the investors that know how to make it going up and down, where you guys basically, you just, you know, buy it going up and you sell it going down, and, you know, you lose every time. So again, what can the little guy do? I mean, yes, we have financial advisors that are supposed to help us with that, but is there an intermediate strategy where you can take advantage of some of those downturns, where instead of, you know, selling emotionally and then buying back when it's going up and you're losing and you get that 4.5% return instead of the 7 or whatever that was. Is there somewhere in between where advisors have the competence or the experience to be able to capture some of that benefit that the institutional investors seem to get?
Thank you. Can you hear me okay, Walt?
I think so, yes.
Yeah, so thank you very much for the question. So first of all, I think you answered part of your own question, which is to trust your advisor. And I do not say that tongue in cheek, right? They not only are our advisors, and I was advisor for a minute, tasked with helping to provide perspective, not tell you what to do, but advise you on perhaps what's most likely to happen. But also they partner with people, asset managers like PIMCO, right? We are the institutional money. And typically, and why I pulled this chart back up, you see those green bars? That's the retail money. That's what Paul and Barbara are doing, right? Yep. That's not what the PIMCOs are doing, what the StatonWalshes are doing, right? Typically, it's the retail money that gets beaten down, and these things become unloved, and that's when the institutional money, or as they lovingly call it in the industry, the smart money, jumps in, really where they have the size and scale to ride out the markets more so than the retail investors. So I always think the best strategy for me personally is just to pause, maybe say a prayer, and then call somebody I trust, to be honest with you.
Right.
Yeah, I'd like to answer that from kind of our perspective, from an advisor's point of view as well. You know, I think that there's often a misconception about this separation between retail money and institutional money, which in today's world with discount brokerages and other resources available, you know, low cost resources for a do-it-yourselfer, there is some separation. I think it's gotten more prominent in recent history. But a lot of what Phil's talking about and some of the things on this chart, institutional money or the big moves in the market where you're seeing, you know, that inflow and outflow sometimes is determined by the behavior of a retail investor. So what I mean by that is our clients call us and say, we need to pull everything out of the market. So in a mutual fund world or an ETF world, they have, you know, what are referred to as redemptions, meaning people want to cash out of positions. They need to sell certain securities in order to raise cash to make that distribution. So it's kind of a domino effect to some degree, is that the retail investor panics, they request money to move out of the market. The institution is forced to raise capital in order to provide them with that money. And so we see there's steps in the process where the two are in many cases intertwined. And so, you know, financial news does this really good job, especially recently with hedge funds and shorting and, you know, the retail investor versus the big institution. A lot of times when you're investing, with the exception of a discount brokerage and you buying your own individual stocks, you know, you both have a mutual relationship and a mutual goal of making money. That's what the fund managers want to do for you, just like PIMCO. You know, Vanguards of the world, Schwab, you know, name any big name that you've heard of, you know, that's their goal. That's their goal at the end of the day. But if the bulk of the market moves in a way that, you know, some of the poor behavior that we discussed today, and they let those biases overtake their investment decision making, that's where we can see a compounding effect of, you know, there are logical reasons why the market is pulling back, and now we're compounding that by everyone reacting negatively or potentially the wrong way by now pulling their money out and creating this chain of unfortunate events. And that's typically what happens. People don't think about it that way. That's kind of our job, and that's where we serve as that intermediary between the retail investor and the institution, and keeping the two together with that same common goal of helping make money for our clients. So, you know, that's kind of that's our perspective on to answer your question.
Okay, thanks for that. Appreciate it.
Vince, you have a question?
Yes. First off, thank you so much for your all's presentation. This was super helpful. Really enjoyed it. So I had a question regarding cryptocurrency and the current trends that are happening today, particularly around the latest news last week that Morgan Stanley has now enabled high net worth individuals to begin investing into cryptocurrencies, particularly Bitcoin. And I wanted to better understand the strategy that you all are now approaching with how the access to cryptocurrency is been really provided to more high net worth individuals and risky millennials, and how is that kind of evolving over, you know, the latest news over the last 3 months, and also what you guys are projecting in the next 5 years?
Oh, I'll take that question, Phil.
Thank you.
Take you off the hook. So the short answer to your question in terms of offerings, it's going to be limited. My guess would be for a little while. There's a lot of different reasons. Financial institutions, especially ones that have banking arms and investment banks, have tons of regulatory red tape that they have to cut through to get to that point. There's also things like risk, insurance to protect against that risk. So referring to Morgan Stanley, you know, they came out and said that anyone with an account with $2 million or more that has been with the firm for a period of time, that's basically an accredited investor that meets the risk tolerance, could buy up to 2.5% using these newly available cryptocurrency funds. So it's basically an indirect ownership of cryptocurrency, and similar to an ETF in the technology sector, for example, you know, same concept. I think that, you know, more banks are going to get on board with that. I just don't know that it's going to be a fast moving thing. You know, the reality is, back to some of our biases and chasing trends, you know, banks see opportunities, and investment banks and even institutions like the ones that we use see opportunities to capture a portion of the market and maybe bring some investors on board. And so they're always looking for ways to differentiate. That's one. That's obviously a unique thing. In terms of offering it to an investor that doesn't meet and that's not considered an accredited investor, that I think we're a long way away from that. That's just my opinion. You know, that could change. If in our practice, I think that, you know, we are kind of stuck in the same box that most other institutions are, which is, you know, we have compliance, we have insurances like errors and emissions insurances that we have to keep up with, and sometimes they cover things and sometimes they don't. You know, being fully transparent, we make a recommendation that our insurance doesn't cover and you lose money, comes out of our pocket. So you know, we make recommendations based on, one, obviously, you know, basic investing principles, but also understanding an individual situation and understanding you know, where they can add additional value, if that means an alternative asset class, whether that's cryptocurrency, whether that's some other alternative like commodities, real estate, other things of that nature. You know, we get into all that. In terms of having it available, readily available for the average everyday investor, I'm not sure that that's right around the corner. I think that's a much longer process. Did that answer your question?
Yes, thank you.
Okay, perfect. Any others out there?
I'll jump in again if nobody else is.
Sure.
So there's been a lot of conversations in the last 6 to 12 months about this soon to come fall at this point in the market, given the fact of the amount of money that's been pumped into the market, potential impact of inflation, things like that. How are you all approaching some of this potential, you know, future falls, or what is the confidence that you all are instilling right now into your clients in the way that you guys are enabling them to position themselves for the next, I'd say, 3 years time horizon?
Yeah, so there's a couple different parts to that. And for people that have worked with us for a period of time, you know, we use a lot of technology in our practice in order to have specific conversations around risk. So one of the tools that we use quite a bit, and anyone on the call that has seen it, kind of knows how it works, but we use a software called Riskalyze, which really is it's a risk tolerance tool, but it also focuses a lot on investor behavior. So every conversation that we're having with an investor obviously can be very specific, but ultimately what we're trying to do is understand risk appetite over the long term, but also in certain increments of time. So just to give anyone who's not familiar with it some background, one of the things that Riskalyze does is it gathers data from around the market and looks at probabilities of market movements in a particular portfolio. So if I pick that same 60-40 spread that Phil had in the presentation, that may have a potential over the next 6 months within a 95% confidence range, meaning we can predict with 95% probability it can be up or down anywhere in between these two numbers. It could be up 20, down 15, for example. So we have a lot of specific conversations with clients about, is that 15 more so on the downside, because we talked a little bit in the presentation about pain of loss versus the enjoyment that people get out of gains. We focus a lot on that red number and say, is that going to incentivize you or motivate you to make a move to move your money out of the market, for example? So those outflows. We want to understand, markets are cyclical. I know that it's been, obviously with the exception of last year, most people in our generation have experienced up markets. I mean, from the bottom, from trough to peak of the market, you're talking 400+%, from the financial crisis in 08, 09 till today. So that's something that, the belief of, stocks only go up has been born out of a really long period of time of success in the markets. We know that that doesn't happen. And so one of the conversations that we have using this tool is, let's look at markets over a longer period of time and figure out what kind of swings can we experience. So there's a report in there called a stress test that looks at, had you owned this portfolio during the financial crisis, what would have happened? And you can match it up. So if you were in the S&P 500, you were down 55%. In this portfolio, you may only have been down 30. Is that still too much? And we can use asset classes like Bitcoin, like any risky stock. If someone had all Tesla stock, for example, and we can show all of that and kind of paint a picture of what we think might happen. Obviously, full disclosure, past performance is not an indicator of future results, but it gives us an opportunity to collect data on how portfolios perform. And based on that, it becomes a behavioral conversation. Are you willing to stomach a 40% loss with the understanding that if you stick this thing out for a period of time, your anticipated rate of return over the next 30 years might be that 6% on average? Or if it's going to motivate you to move in and out of the market, we know we're going to create that behavior gap, unintentionally, but it's going to happen. Happens to everybody who doesn't, show discipline in those periods of market volatility. So the short answer to your question is, we use some tools to gauge that, and it's all based on an individual investor's risk and more about what they're willing to accept in terms of a negative number on their statement versus what the expectation is, or I guess can compare it to long-term expectations of rate of return, and we kind of match those two together. All right. Any others? Denny, have another question? I see you smiling there.
I'm good, thank you.
All right.
He's got his brother standing next to him.
Hey. I couldn't tell.
No, they don't look anything alike, do they?
No, if there's not any other questions, and obviously, just so everyone out there knows, we're always available to answer questions after the call. If you want to ask something more personal offline, or just anything comes up when you're thinking about this, or when you get the recording or the presentation, don't hesitate to reach out, whether you're a client, partner, not a client of ours. We're always here to help. We're going to have more great presentations like this. And I just wanted to thank Phil specifically today. Did a great job, great content. So we're very appreciative of our partners over at PIMCO. And so with that, I think, Devin, we're good to go, right? And unless anyone has any other questions.
One thing to bring everybody's attention, we'll be having a first quarter market review in middle of April. So we'll send out an invite to everybody on that, as well as we'll follow with everybody from this presentation who RSVP'd with a copy of the presentation and some other material from PIMCO as well.
Well, thanks, Three Amigos.
Awesome.
Great job. Appreciate your time and your expertise.
Thanks, everybody.
Great. Thanks, everyone.
Awesome.
Take care.
Thank you, guys.
Bye.